Good morning and welcome to Capital Sound. Here's the detail that's hanging over everything before the bell. Asian markets pushed higher overnight on renewed hope that the U.S. and Iran can get to a deal soon, and that the Strait of Hormuz, that critical oil lane, stays open and calm. That one storyline can make today feel either like a relief rally or like the market is whistling past a very real risk.
Morning, Mandy. You can almost feel the market trying to decide whether to treat this as storm clouds clearing or sunshine that might not last past lunch.
Exactly. And that's our debate setup for today. Is the market right to look past energy and geopolitical headline risk and keep leaning into growth, especially anything tied to AI? Or are investors getting ahead of themselves, pricing a clean outcome that isn't guaranteed?
That's the right tension. And I'd add a second layer. Even if the headlines improve, we're still living in a world where discount rates matter again. If rates drift higher, a lot of the market's favorite long-duration stories can feel it.
For listeners, Victor Stone is with us, our value sage. Victor, you're the guy who tends to say, show me the cash flow, show me the balance sheet, then we can talk about the story. So let's make this a clean debate. I'll moderate. You give us the bull case first. Why today could be constructive for stocks?
All right. Bull case starts with the simplest thing. Markets like fewer unknowns. Overnight, the unknowns around shipping lanes and energy supply felt a little less scary to traders, at least in the moment. When you get that kind of relief, money often rotates back toward the areas that already had momentum: big tech, semiconductors, and the broader AI supply chain.
And we did see that theme in the news stack. Musk's team reaching out to chip equipment suppliers for that terafab concept. It's not earnings, but it's a signal.
It's a signal, and value folks should still take it seriously. Not because we chase the newest shiny object, but because capital spending plans, real ones involving real vendors, tend to show up later as revenue for someone.
Walk us through it in your language. How does a value investor interpret that kind of headline without getting swept up?
I start by asking, who benefits in a way that's durable? In chip equipment, the better businesses are the ones with two traits: recurring service revenue and a long runway of demand that isn't dependent on a single customer's mood. If you're a supplier with a deep install base, you're not just selling a machine, you're selling years of parts, service, upgrades, and process support.
So the bull case is AI CapEx is sticky, and this headline adds a little fuel.
That's fair. And here's the everyday analogy, just one. If you've got a paid-off farmhouse, you don't remodel the kitchen because you're feeling emotional. You remodel because you've got the cash flow and you plan to live there a long time. Serious CapEx tends to follow that logic.
You're saying the check writing matters more than the press release.
Exactly. Now, quick caveat in bull case form. This stays constructive assuming rates don't spike and drain the oxygen out of those long-term cash flow stories. If that oxygen gets thin, the market's mood can change fast.
Good. One risk note, not a panic note. Keep going. What else supports the bull side today?
The second bullish support is bonds, oddly enough. There's a view out there, Allspring made the rounds with it, that inflation pressures may be cooling, and that adding duration could make sense if the Fed stays on hold. Even if you're an equity investor, a bond market that behaves itself is a friend.
Because it keeps the discount rate from running away.
Right. It's not that lower yields magically create profits. It's that stable yields help investors pay a steadier price for those profits. If you want a decent trading day, calm rates is a pretty good ingredient.
But you're also looking at oil, and oil is the spoiler. That's been our recurring thread this week, energy math.
It has, and the bull would argue. If the Strait of Hormuz stays open and the tension cools, oil stops acting like a tax on everything. Then companies can get back to business, consumers stop hearing scary gas headlines, and you get a little exhale.
Let me summarize the bull case in plain English. Less fear overseas, bond yields not doing anything dramatic, and AI CapEx keeps humming. So traders come in with a risk-on posture.
That's the shape of it. One more if I'm wrong statement, because we have to respect reality. If that deal hope turns back into confrontation headlines, the relief trade can reverse quickly, and anything priced for perfection, especially the expensive growth names, can wobble.
Okay, that's the optimistic read. Now flip it. Bear case. Why today could disappoint?
Bear case starts with the very thing that's making people optimistic: hope. Hope is not a supply contract. Hope is not a signed agreement. Markets can get ahead of themselves when the story is comforting.
So you're skeptical of the peace deal optimism being durable.
I'm skeptical of treating it like it's done. And from a fundamentals lens, the economy doesn't need an all-out crisis to take a hit. It just needs persistent uncertainty that changes behavior. Companies get cautious on hiring, customers stretch payments, and CFOs become more protective of cash.
That connects with another story in the pile: the mega layoff template spreading, more right sizing, more do more with less.
Yes, and I want to be careful here. Layoffs can boost near-term margins, but they can also be a canary in the coal mine about demand expectations. If management teams across industries are standardizing lean staffing as a default, it can be prudence, or it can be a quiet admission that growth is not as sturdy as the market wants.
And as a value investor, you're always asking, what's the quality of the earnings?
Exactly. If earnings improve because you cut, that's different than earnings improving because customers are lining up. In the short run, traders may cheer efficiency. Over the long run, the best businesses don't hollow themselves out.
Give me the other bear pillar.
Discount rates. We've been talking about it on Capital Sound with your other guests in different language. Rajiv last night had that line about a victory lap before the officials finish inspecting the car. The way I translate that into value speak is, when valuations are already rich in parts of the market, you don't need bad news to struggle. You just need less good news.
And Milan's point a couple days ago, it's not about panic, it's about arithmetic.
That's the one. If oil stays elevated, it's arithmetic. Some costs go up, somebody's margins go down, and consumers have less discretionary room. Even if the economy isn't derailed, the market multiple people are willing to pay can compress.
You're basically saying the tape can look fine until it doesn't, and then it moves fast.
That's a fair description. Another piece in the bear case: AI CapEx headlines can be a double-edged sword. They're bullish for equipment suppliers, but they can also signal an arms race where returns get competed away. If everyone builds the biggest barn in the county, somebody ends up with too much capacity.
That's metaphor number 2. I'm counting.
Fair. I'll keep the barn doors closed after this. The point is, capital spending booms can create winners, but they can also create overbuild. For today's trading, if investors start asking who actually earns good returns here, you can get sharp dispersion. Some names up, some names down, inside the same theme.
I want to tug on something you said: priced for perfection. We have a seeking alpha style narrative floating around that markets are ripping and maybe getting ahead of themselves. How does that show up in today's session?
It shows up as fragility. If a market is positioned for everything goes right, then small disappointments matter. A slightly hotter inflation read, a sour bond auction, a sudden oil jump, or an ugly headline, those can turn the day from green to choppy. I could be wrong if the deal progress is more concrete than we think and oil cools off meaningfully. Then the market's optimism has firmer footing.
So you've given us a real bear case without doom. That's helpful. Now let's do cross-examination. I'm going to challenge both sides because listeners are trying to plan their day.
Let's do it.
First, on the bull side, you're leaning on stable rates help. But what if the bond market doesn't cooperate? What would you watch early today to know if the bull case is unraveling?
I'd watch whether yields drift higher alongside oil. If energy moves up and rates move up, that's a tough cocktail for most equities. It's not just one sector then, it's the discount rate pushing down on everything, and the cost line pushing up on many businesses.
And on the bear side, is the risk already known? Geopolitical worry, oil worry, don't get ahead of yourself. People have heard that for days. Why wouldn't the market just shrug again?
It might. Markets can stay casual longer than logic says they should. The reason it can still matter today is timing. If traders come in optimistic and then get even a mild negative headline, you get that air pocket effect. It's not that everyone is unaware, it's that positioning and psychology can turn small news into a bigger move.
So your view is less the world is ending, more the market is leaning.
Exactly. When the canoe is tilted, you don't need a wave, just somebody shifting their weight.
I like that image. Now, I'm going to press you on a very specific story. The crypto governance drama, big personalities, governance complaints, token unlock schedules, all of it. Does that matter for today's broader tape, or is that just noise?
For the S&P type investor, it's mostly noise, but it's not meaningless. It's a reminder that governance isn't an academic word, it's about who controls the economics. In public equities, we watch that through voting control, buybacks, dilution, and incentives. In crypto, the same human issues show up, just louder.
So you're saying it's a sentiment barometer?
Yes, if risk appetite is strong, those stories get dismissed. If risk appetite is shaky, those stories start feeling like a warning label. Be careful where the rules can change.
Speaking of governance, we also saw a ratings agency downgrade for the Australian Securities Exchange after governance and risk management failures were flagged. That's not the U.S., but it's a pretty pointed headline.
It is. And it's another small sign that trust in systems has a price. A stock exchange is supposed to be boring in the best way. When boring institutions get governance headlines, investors start asking whether they're being paid enough to accept operational risk.
Let's bring it back to the debate and force a conclusion. Where do you actually lean for today's session? Are we set up for a smooth, constructive day or a messy one?
I lean choppy to constructive with a narrow path. I can see a positive open if overnight optimism holds, especially if oil behaves and rates stay calm. But I don't expect an easy straight line.
Narrow path, say more.
Think of it as speed bumps, not sinkholes, as long as headlines stay cooperative. You could see tech and semis try to lead early on that terafab-style capex excitement. But the market may quickly test the mood. Are we paying too much for growth? If that question gains traction, leadership narrows and defensives look relatively better.
And if it's choppy, what are the tells intraday? What should listeners watch without staring at every tick?
3 simple tells, no fancy chart stuff. 1. Oil's direction after the open. Does it cool or creep higher? 2. The bond market vibe. Are yields steady or do they grind up? 3. Breadth. If you see only a handful of mega caps holding up the whole market while a lot of stocks sag, that's a fragile day.
That breadth point matters because it changes how you interpret the headline, indexes are up.
Exactly. A market can look calm on the surface and still be internally tired.
Okay, let's make this practical without drifting into advice. Sectors and stock types to watch today, what's on the radar?
On the optimistic side, semis and chip equipment because capex headlines tend to pull attention there quickly. If those names are strong early but then fade, that tells you the market is selling excitement.
That's a great point. Strength that can't hold is information.
On the more defensive side, energy is a hedge to the headline tape and certain healthcare and staples businesses that have predictable demand. For value investors, I also watch high-quality industrials with pricing power, companies that can pass along cost increases without losing customers.
And on the flip side, where might the pressure show up if the bear case takes control?
The most sensitive spots are the expensive stories where profits are expected far out into the future. If rates drift higher or oil spikes, those can wobble. Also, consumer discretionary can get jumpy if gasoline headlines dominate, because it's a reminder that the consumer's budget isn't infinite.
You're giving us a map. Watch AI-linked capex names for leadership, watch oil and yields as the mood setters, and watch breadth to see if the rally is real or just concentrated.
That's the map. And for long-term listeners, if you're building a watch list rather than trading the noise, days like today can be useful. When the tape gets emotional, you sometimes get a better look at what you'd want to own at a fair price versus what you only liked because it was going up.
That's very on brand for you. Before we close, I want to revisit the debate question one last time because it's the heart of the morning. Is the market getting ahead of itself?
My answer is, it might be leaning a little optimistic, but it's not irrational. If the world genuinely de-escalates and inflation continues to behave, equities can justify holding up. The one thing that would challenge that is if oil stays high enough, long enough, that it feeds through into costs and keeps rates from easing. If that changes, so does the thesis.
That's our grounding line for the day. Watch oil, watch rates, and don't confuse hope with certainty.
And keep your standards. The wonderful businesses still look like wonderful businesses on messy mornings. The ones held together by sentiment, those are the ones that show cracks first.
Victor, thanks for helping us frame it as a real debate instead of a slogan.
Always happy to bring it back to cash flow and common sense, Mandy.
All right, everyone, Keep an eye on those early headlines, especially anything that shifts the energy picture, and watch whether the AI CapEx excitement actually holds through the morning. Thanks for spending part of your morning with Capital Sound. We'll be back soon with more perspective as the story evolves. Have a steady trading day, and goodbye.
Take it slow, keep your footing, and I'll see you next time.